Hello, everybody. Brett Swarts, your capital gains tax solutions. A question that's been coming up quite a bit with some of my clients and some of the potential people that are looking at the deferred sales trust for the first time, which is what's more flexible, a deferred sales trust or a 401k? Now, there are some similarities and there are some differences, and really the big thing becomes the flexibility of the deferred sales trust and what that provides for you. But I want to bring in a video here from one of a YouTube superstar. His name is Graham Stephan, and he's going to talk to us a little bit about the 401k, and I'm going to do some commentary as he does and really break this down for you so you have a clear picture of what this looks like. So let's bring in Graham right now on this video.
Well, the traditional 401k is an employer-sponsored retirement plan where you contribute pre-tax money into this account, which means you won't pay any taxes on the money that you contribute. Now, because you don't have to pay any tax on the money you contribute to this account, this means that you have more money left over to invest instead of paying it to the IRS.
So just like the deferred sales trust, it's exactly the essence of this, right? Because you don't have to pay at the close of escrow 25 to 50% in capital gains tax and depreciation recapture. You have more money, or the trust has more money to invest, which in turn you can live off the interest payments from the trust. Now, you also have more money to invest. And this is where the flexibility comes in. That's pretty radical with the deferred sales trust, and that you can put it into active real estate deals. You can put it into cryptocurrency. You can put it into passive real estate deals. You can put it into diversified liquid investment grade securities, stocks, bonds, and mutual funds. But you can be an active participant in that. And you can also be a passive. So you can be retired, or you can be working and be entrepreneurial. So the key here is pre-tax dollars, right? Before their tax, growing and earning interest. And so let's keep going here on this video, and let's see what Graham has to say regarding the upside of the deferred of the 401k, and then we'll talk about more how it compares to the deferred sales trust.
And with that extra money, you can then go and invest it to make you even more money. Then after the age of 59 and a half, you could begin withdrawing the money that you have in a 401k, and you just end up paying the taxes you would have owed later at that time. So basically, you're avoiding paying taxes on that money right now, just to end up paying it off later at the time you actually take it out of the account. But the advantage to doing this, complicated answer, and it's definitely not a one-size.
So let's pause here. So in that scenario, here's this really interesting, right? So the deferred sales trust, it has that same concept in that as you receive payments, you pay some tax, some ordinary income tax. And as you receive principal, you pay the capital gains tax. Although the nuance here is that most of our investors are just living off the interest payments. They're not actually dipping into the principal. In fact, you can pass it on to your kids, and they can continue this tax deferral. And so it is tax deferral, and there are taxes. But the question is, if and when you receive the payments is when you actually pay the tax. And so whereas the 401k, as you're going to see here in a minute, some of the limitations to it have to do with the 59.5-year-old having to take minimum required distribution. So let's take a look at what he says here.
Then after the age of 59 and a half, you could begin withdrawing the money that you have in a 401k, and you just end up paying the taxes you would have owed later at that time. So basically, you're avoiding paying taxes on that money right now, just to end up paying it off later at the time you actually take it out of the account. But the advantage to doing this is that you have more money left over up front to invest with, so you have a larger amount working for you to make you even more money. And just like the Roth IRA, here are the positives of doing this. The first and main benefit of doing this is that you contribute what's called pre-tax money, which means that this is money that has not been taxed, and this is actually a pretty substantial tax write-off. So this means, for example, if you're in a 32% tax bracket and you contribute $19,000 to a traditional 401k, this will save you $6,080 in taxes. And this means an additional $6,080 that you can then go and invest to work for you instead of paying that to the IRS.
Okay, this is a huge point. We call this tax at Capital Gains Tax Solutions. And it's the concept that if you can delay income and or lower your overall income or your principal that you're going to receive in a given year, you can move into a lower tax bracket overall. So I'll give you an example. We closed a deal in Palo Alto for about $8 million. And this particular gentleman had about a $2 million or so gain. and he had about $800,000 as a primary home in potential tax. And so this would have shot him into the highest tax bracket, right? And put him into like, the 45% range, because all of that capital, not only is it capital gains tax, but it increases your income tax rate, especially in California. And so one of the things we try to practice at Capital Gains Tax Solutions is tax flow, not just cash flow, which means we were able to structure the deal where he's delaying the payments from the trust. He's also delaying the interest payments from the trust, which leads into the next concept, which is he moved to Nevada, and he established a residency. And so in this scenario, he's able to take the cash flow from the trust, but he's a resident of Nevada now, no longer California. So not only did it lower his overall tax rate in the given year in California, but then he established residency in the new state, which no income tax for that state. Now, question is, well, if he dips into principal, will he pay California capital gains tax? Absolutely. They're always due their money. You can't just, move to Puerto Rico and sell $100 million company and then establish residency and then get out. There, you're always going to owe where it's owed. But the question is, will he actually dip into principal? That's the question. And most of our clients will not. Most of our clients will just keep the principal intact. They'll live off the interest payments. They'll reinvest it, and they'll make interest off of those funds and continue to grow the trust account. So let's keep going here and see what else Graham has to say about 401ks.
Now, secondly, you can contribute up to $19,000 per year in a 401k, and that is more than 3 times higher than what you can do with a Roth IRA. Now, third, some employers are going to offer you what's called an employer match in a 401k, and this is where they match you dollar for dollar for whatever you contribute into this account. Now, in terms of investment ROI, this is the best guaranteed, risk-free, 100% return investment you will ever get in your entire lives. Always do this, no matter what. At least always take the employer match, and at least always smash that like button if you haven't already. But no, for real though, at least just promise me this is something you will do. This is one of the biggest benefits of contributing to a 401k, is having the employer match. If you have this, always take advantage of it no matter what. But now, of course, with that said, unfortunately, there are some downsides with the 401k that I do want to mention. The first one is that even though you don't pay taxes on that money now and you save all of it, you're going to end up paying taxes on that money after the age of 59 and a half whenever you take the money out of that account. So with a 401k, hopefully you're saving on taxes now when you're in a really high tax bracket, to then withdraw it later on when maybe you're not making as much money in a lower tax bracket, and then you end up profiting that difference. Now, secondly, if you want to take out any of the money in a 401k prior to the age of 59 and a half for anything other than financial hardship, you're going to be hit with a 10% penalty, and you're going to have to pay ordinary income taxes on that money, which is a lot higher than you paying long-term capital gains because you've held that investment for a long period of time. Now, the third downside I see with this is that you're going to be forced to withdraw some of this money beginning at the age of 70 and a half. Which, if you want to keep it in there and just let it continue growing, well, you can't. So now with all of that.
Okay, so here's some cool things to break down here, right? So you mentioned a number of things with a 401k that are pros and cons. Now let's compare that to the Deferred Sales Trust, and the first one being the contribution limit. He mentioned there's about $19,000 limit per year. There's no contribution limit for the DST. In other words, it doesn't matter what the size is. Now, there is some interest charge above $5 million per person per year on a traditional DST 1.0, but the DST Plus or the DST 2.0, there's no limit, meaning you could sell a $100 million property, business, cryptocurrency, and you can exit into what's called the DST Plus, and we can actually remove that outside your taxable estate. There's no limit to that. DST 1.0, there's no limit. However, there's an interest charged if it's more than $5 million per person, per year in deferral. And so that's where we typically structure deals that are 10 million and below. With the flexible DST 1.0, deals that are above that amount, we're going to do the DST 2.0. Same cost, but one's more for estate planning, and the DST 1.0 is more for your living expenses during this year, or your lifetime is a better way to put it. And by the way, you can check out that whole video on the DST 1.0 versus 2.0, and I have a full video on the DST Plus, so you can check that out on my YouTube channel. Okay, he also mentioned the cons of the 401k being there's a penalty, right? There's a penalty if you take out the funds prior to a certain age, which is 59 and a half. So the deferred sales trust, there's no penalty. So that's also a cool thing about the flexibility. I mean, there's the tax, which you're going to pay and which you owe, which you've been deferring. So that's a part of it. But if you want to, if the trust is going to be wound down and you want to get out earlier, or you need capital, it can make the distributions to you. It can also be unwound, and you can just pay your tax as you receive it. And to mention as well, the capital gains tax rates could be higher or lower in that given year. So if they're higher from when you sold it, let's say today and 5 years from now, they're higher, you're going to be paying those higher capital gains tax rates. So that's a downside. If it happened to go lower, you get the benefit there, but that's not likely. So keep that in mind. But there's no 10% penalty above and beyond that, right? Whereas the 401k has that. Now, he also mentioned the 70-year-old forced distributions. The deferred sales trust doesn't have any forced distributions by law. Although the way we structure our deals, we're typically seeing some payment out within the first 2 years. It doesn't have to be the full interest payment. Our deals are structured typically at 8%, a net of recurring fees, a compounding interest rate. So let's say it's $1 million at 8%. That's an $80,000 interest rate. But you don't have to take all $80,000 out in any given year. In fact, you can delay it for a couple of years, and then we can start taking payments out. And in those couple of years, it's just compounding and building, right? Especially if you're relocating to a new location, a new state like a Florida or in a Texas or Nevada, where it's a lower income tax state. Or second, you're like some of our entrepreneurial clients who are selling a business and you're staying on for a couple of years, right? There's some kind of earn out and you have a commitment for 2 or 3 years where they're still going to be paying you a salary. And then you're going to get maybe the additional payout then, some up front, but we can be delaying the interest payment out to you up front. And then we can turn on that interest payment in a couple of years, depending on the deal. Everything's a little bit different, but those are some strategies we use. So although there's no forced distribution of any given amount, we do have payments that will be made out, and typically in the first couple of years. So that is the next part of this. Let's keep going on the video and see what else Graham has to say, and I'll give some more commentary.
Said which one is actually the better option and which one should you contribute to. So let's first start with the Roth IRA. Now, since this is done with post-tax money, meaning you don't get any immediate tax deduction on the money you contribute to this account, this is best done when you're young, in a low tax bracket, and not already making a lot of money. Or basically, it's better when you know you're going to be making more money in the future, and because of that, you're going to be in an even higher tax bracket. On the other hand, a Roth is not a good investment if you're making a ton of money right now in your prime earning years, and you expect to make less money by the time you retire.
Okay, so he's talking about the Roth IRA here too, right? Which is, this video is more about the 401k, but this concept actually does apply to the deferred sales trust. And it kind of what I said before, I want to make sure you connect the dots. So you might be making a very high income right now as you own a property or you own multiple properties. You have a lot of assets that are paying you a lot of cash flow. In fact, you might even have no depreciation. I'm working on a deal right now in Sacramento. It's worth about $15 million and it's fully depreciated, and it's also producing cash flow about $600,000-$700,000. And this particular client, he's going, Brett, I'm getting hammered with tax because I have no depreciation. And if I do a 1031 exchange, my old depreciation schedule is going to travel. And so is there a way with the deferred sales trust to not only sell and defer the tax and defer the income coming to me because I'm in California for a couple of years, but then also when I partner with the trust to go buy another property, get a new depreciation schedule and get that tax flow depreciation to write off? And the answer is yes, the way we can structure it. So think of that like the Roth, although they pay up front, anything that grows is tax-free. The deferred sales trust, you're deferring it up front, but then you can use the trust if you're an active investor to go buy real estate and then get some depreciation. You can build up that account, right, to offset the cash flow. And so it's a brilliant way to tax engineer and get cash flow and tax flow, kind of like a Roth, in a sense that you're getting what you wouldn't have had in depreciation, tax-free, if you will, although you have to buy a property and you might have to take on debt and find a deal that makes sense to offset the cash flow that you were already producing before that you didn't have depreciation or write off. So hopefully you got that. Rewind this if it didn't make sense, but let's keep going on this video to see what else Graham has to say.
Like, let's say right now you're running a business and that's making you $300,000 per year, but you know this is not going to last forever and you don't expect to really be making more than like $80,000 a year by the time you're 60. Well, in this case, you're in a high tax bracket now, but again, by the time you retire, you're going to be in a much lower tax bracket. So in this case, it's smarter to take the 401k deduction at the higher tax bracket and then pay taxes on it by the time you're making less money in the lower tax bracket, and then you save that difference. And of course, in my opinion, that's really how these accounts should be prioritized. And the reality is that most people in retirement will not need as much income as they need right now. Potentially, by the time you retire, you're going to have a paid off home and you're probably not going to be working full time. And because of that, you're not going to need as much money to survive. And then because of that, you're going to be in a lower tax bracket, which is ideal for withdrawing your money from a 401k when you pay tax at that time. So for people in this position who are making a ton of money now but don't necessarily expect this to continue in the future, a traditional 401k could make a lot of sense, especially if you're in a 32 or 34% higher tax bracket and you expect to retire in a lower tax bracket. However, there's also a very large percentage of people out there who expect to be like balling in retirement and just making a ton of money, and I expect to probably be one of those people. Even though I'm currently in a ridiculously high tax bracket, I expect myself to make even more money in the future, and I can't expect myself ever not to work and make money. So it kind of makes sense that I should contribute to a Roth first, knowing that in the future, if I make more money, I'm not going to have to pay any additional taxes. Now, another concern I have with prioritizing a traditional 401k is that we have no idea what the tax situation will look like 30 or 40 years from now. For example, the tax rates could be significantly higher than what they are right now. And if this is the case, you could end up paying way more taxes in the future than if you made the same amount of money today. And that.
All right. So he brings up some really good points here, right? And let's start with the last one, uncertain future tax rates, right? And that is something to consider, because just because these states are no income tax states for the interest payments, like Nevada or Florida or Texas, or Puerto Rico, even very low, you're looking at potentially going higher. I mean, the government has $30 trillion. But again, most of our clients, the way we structure our deals, they're never eating the goose that lays the golden egg, meaning they're never dipping into the principal amount. So that cap gains tax rate, which also could be higher or lower, most likely higher in the future, they're not actually paying that because it's in a deferral state and there's no forced minimum required distributions. And you can also put it inside of your living trust, and it can be passed on to your heirs. Your heirs can step into your shoes. They don't get a stepped up basis because remember, it's a loan. It's not an ownership of the trust. You've loaned the money to the trust, and your heirs can step into your shoes and continue the tax deferral and the payments. But the payments, he's absolutely right? Depending on where you're at and what location you're in, let's hopefully have some more favorable tax rates for certain states, right? Depending on where you live, that is something to consider. But again, if your deal, that's why we like to see $1 million net proceeds, $1 million gain is our minimum. If your deal is as big as that, and meaning you have tax between 25 and 50% of that, which is $250,000 to about $500,000 of tax, the deferred sales trust, we say makes a whole lot of sense because the rule of 72 can kick in, which says if you can earn 7% compounding rate of return net of fees, which over any 10-year period of time, that is the goal, not a promise, not a guarantee. We can double the money that you would have paid, right, in tax, and double the money that's in the trust. So these are kind of the mathematical equations that we've kind of broken down to make it make sense. Okay, so that is really important. Let's see what else Graham has to say, and then we'll finish up this video.
That, of course, is very, very bad. I just see it as being too many variables that could affect the potential tax rate positively or negatively in the future that none of us can predict. So given all of that information, here's my own personal recommendation of what I would do. And of course, this is not financial advice for entertainment purposes only. That's my disclosure right there, so no one get upset. This is just my opinion. Do your own research on this, obviously, and don't listen to some person on YouTube. So anyway, with that said, if it were me, if you're young and in a low tax bracket, the first thing you should do is prioritize the Roth IRA. You're not going to regret that when you're older, and I pretty much consider this a sure thing. Your tax-free money is going to be worth a lot more in the future. Or on the other hand, if you're making a ton of money right now in a super high tax bracket, and you don't expect that to last, and you expect to retire in a much lower tax bracket, then potentially you may want to prioritize the traditional 401k, take the write-off now at the high tax bracket, withdraw the money in a lower tax bracket, and you'll be left over with more in the future. And the right
Okay, so a little nuance here, right? So the difference between the deferred sales trust and like a Roth IRA or a 401k is that you can actively buy investment real estate, which you can get that depreciation, right? So you're going to kind of get the best of both worlds. You're going to get the initial tax deferral that a 401k gives. And then again, just to break this concept down, you can partner with the trust and become an owner of an LLC, which buys investment real estate, which then in turn you can get new depreciation schedule. And this depreciation schedule that builds up can offset the cash flow from the trust and from the real estate, all tax deferred. Okay. It's a powerful way to build wealth. In fact, that coupled with bonus depreciation and cost segregation that's going on right now for multifamily investment properties and pro-business states. I just did a whole video on a deal that I just toured in Texas. We are always looking and building, finding and investing in deals with some of the best operators and partners in the country. And so you can check out how we do that. So it's not just tax deferral, it's also cash flow, but it's also tax flow and how those two connect together, right? And so Rich Dad Poor Dad talks about this with right side quadrant, left side quadrant, but it's also breaking down your overall tax flow plan, which is just so important because taxes are going higher. Okay, so these are the things that we love and we want to show you, and why the deferred sales trust is more flexible than the 401k, more flexible than the 1031 exchange for sure. We have a whole series on that as well. And if you want to learn more about this, you can check out our YouTube channel, which you're watching this now. If you're watching it, you can check out our podcast, Capital Gains Tax Solutions. And then you can also check out our new book coming out, Building a Tax Deferred Exit Strategy. And it's the proven playbook for unlocking your ideal wealth plan for yourself or clients when selling any type of highly appreciated assets. You can look for Kevin Harrington from Shark Tank in the book, and a number of other really smart people, multifamily financial advisors in the book. And we want to help you out, and we encourage you to go to Capital Gains Tax Solutions to do that. If you're also watching this and you're a business professional saying, hey, I help my clients do this, look at partnering with us, right? To be able to provide this solution for your clients to help you level up your service to provide for your high net worth clients. Hey, I so appreciate you watching this video. Would you please smash that like button? Would you please share, rate, review, subscribe? And we look forward to connecting with you again on another video, or connecting with you real soon on a live deferred sales trust deal by going to capitalgainstaxsolutions.com. Thanks everybody for